Muy bien, buenos días a todos. Vamos a dar comienzo a esta presentación del informe de petróleo de la Agencia Internacional y como sabéis el acto va a hacerse en inglés. We are going to switch to English to introduce our guest here to present. This is the third time Neil Atkinson is coming here to present that. Today he has a colleague, Toril, Bosoni, both working for the International Energy Agency. Neil is responsible for this report, all these medium-term reports in oil, and very specialized person in this area. He worked before for, I think, all the areas of oil. Before he worked for PDVSA. For many years he worked in Prague and all this. He's a specialized person in all this communication area, all of this. And Toril Bosoni, he worked for the agency for 14 years, more or less. And they are coming here in a good year, no? This year you can download the summary from the International Energy Agency. Is more positive about the future. They are forecasting 2023, I suppose, and they are forecasting good increase in the petrochemicals and a good increase in the demand all around the world and all of this. Well, nothing more from our side. I think you can, after this presentation, we are going to maintain this Q&A session we normally do. And I think you can ask then whatever you want about the prices or whatever you want, the production or whatever you want about all of this, because they are very specialized people and it's very interesting. This is the report we are doing in this meeting there. 3.6. I don't suppose we are presenting the third time this year. Well, I give the floor to Neil. Neil, the floor is yours.
Thank you.
Thank you for coming.
No, not at all. Thank you very much for the invitation. It's always a great pleasure to come. As in previous occasions, we're going to present the key highlights from the 5-year outlook that the IEA has recently published in this document that some of you may already have seen, I'm not sure. The Oil 2018 Report Analysis of Forecast for 2023. And as I say, we'll present the highlights. Very happy to take questions and observations at the end of it. And we're also very happy to take any questions related to the very short-term oil market if you have any. So when we sat down to do our research, to try and understand what the oil market would look like in 2023, the starting points as far as prices were as follows. The IEA does not officially publish forecasts for short and medium-term oil prices. There's enough people out there already getting that wrong without us adding to it. So what we do to do this research is we take the forward price curve that was prevalent at the beginning of this year. We tweak it a little bit. And essentially that demonstrated to us that the average price expectation over the next 5 years or so was roughly $60 a barrel. Now, today, of course, the Brent crude price is $73 a barrel, so the world has changed slightly already to some extent. But when you're looking at medium and longer-term work, you don't adjust numbers just on the basis of the daily whims and changes of the oil price. So our work is based on a $60 price out to 2023, and we modeled the expected changes in demand and supply, and we reach a conclusion as to where we think the market will look 5 years from now in terms of whether it be a tight market or a loose market and the implications of that. So what we'll do is I will start off with the main observations as far as oil demand is concerned, and my colleague Toril, who leads the research we do at the IEA on the supply side, will fill in with the expectations on supply, and then we'll tie up some observations on future trade patterns, and then we'll present the overall conclusion. So, taking demand first, the big picture as far as demand is concerned is that over the next 5 years to 2023, we expect global oil demand growth to be robust. It's going to be pretty strong. By 2023, demand will be about 7 million barrels a day higher than it is today, growing at an average rate of about 1.2 million barrels a day. The starting point for the forecast shows that last year in 2017, demand was stronger at 1.6 million barrels a day. We think it will be slightly higher this year than we show in this chart, about 1.5 million barrels a day. But it's possible that the current high prices might lead to a downward revision in demand growth number. We'll have to wait and see. The main point is, as we move out through 2019 and then into 2023, we see a decline in the rate of growth of oil demand. Still growing strongly by over 1.2 million barrels a day on average, but a decline in the rate of growth. And that is because there are ongoing improvements as far as efficiency standards are concerned. And we're seeing, particularly in countries such as China, which have been used to very, very rapid rates of demand growth in recent years, a tempering of the rate of demand in China as efficiency improvements take effect there, but also as the structure of the Chinese oil economy moves away from the pattern we have seen of investments in very heavy energy-intensive sectors, the construction industry, heavy industry, and as China moves to a more consumer-focused economy, as incomes rise, as the size of the middle class increases, as they move from bicycles to two wheels to four wheels, they will be using more gasoline. As they move to a more consumer-focused economy and they're buying goods in greater quantities than they were before in the retail sector, we'll find that the demand for petrochemicals to service demand growth for consumer products, a rise in diesel demand for the trucking industry in China, but overall China will grow strongly, but the rate of growth will begin to fall away. Meanwhile, India, still very important, but further behind on the development curve than China. China and India taken together will contribute something like 50% of the global demand growth that we'll see to 2023. Now, bear in mind, or keep in mind, the figure for global demand growth increase to 2023, 6.9 million barrels a day. So keep that figure in mind. Specifically in China, we were talking about changes in the structure, and we've done quite a lot of work in this report on the increasing penetration of alternative fuels displacing traditional liquid fuels in transport. And particularly on the right-hand side of these two charts, there's some quite interesting developments taking place. We're seeing very large quantities of diesel being displaced by compressed natural gas. We're seeing it displaced by electric vehicles to some extent. And although we're talking about a development from a relatively low base, we're seeing that China is the largest global market for electric vehicles. They sold about 800,000 EVs last year, which is a 50% growth on the previous year. And we think that at the end of 2017, we're just over 1 million EVs in China. We think that by the end of 2020, there'll be 4 million EVs in China, and that sort of rate of growth will probably continue for several years to come. We're also seeing that in China it's the host to the biggest number of compressed natural gas vehicles in the world. And we're seeing also a big increase in the use of electric buses in Chinese cities as they attempt to curb very high levels of urban pollution. There's a lot going on in China in terms of the penetration of alternative fuel, and it's beginning to have a material impact on the rate of growth for traditional liquid fuels in China. The other issue that we want to highlight is the growing importance of petrochemicals around the world. Obviously, in countries such as China, where consumer demand for consumer goods is increasing, but also generally around the world as the consumer economy marches forward. And what we're seeing is a very large number of petrochemical projects being constructed around the world. The United States is quite noteworthy because until the shale phenomenon took hold there in the last 10 years or so, since the shale phenomenon took hold in the US, there's been a huge increase in the availability of relatively low-cost feedstocks in the United States. So we're seeing an increase in petrochemical projects as they're reshored, as they say these days, from abroad to reflect lower costs in the US. China, a big increase in projects to feed the demand for consumer goods. So we think that over the next 5 years or so, petrochemical feedstocks are going to be responsible for roughly 25% of global oil demand growth. The last big issue we're going to focus in on the demand side is something that you may already be aware of as experts, but there are plenty of other people who look at the oil market and don't quite see what's coming here. And what we mean is that in 2020, as you can see from the quite dramatic stack there is in the center of these charts, the International Maritime Organization is introducing new fuel standards for the shipping sector. They will have to move away from the relatively high sulfur fuel oil, which has been a mainstay of marine fuels, the current 3.5% sulfur fuel oil. They will have to comply with a new regulation which mandates a 0.5% sulfur fuel oil. Now, there are about 90,000 ships around the world which come under the auspices of the International Maritime Organization regulations, and they have choices to make. They have to try to obtain supplies of, for example, marine diesel, which increases the demand pressure for that type of fuel. And of course, there are plenty of other usages for diesel in the global economy, so there will be price pressures on diesel. They will have to compete for a new 0.5% sulfur fuel oil, which we're not entirely sure yet will be available in sufficient quantities in 2020. Alternatively, ships can fit scrubbers to remove the sulfur from the fuel oil on board. There's an awful lot of things going on. Our current feeling at the IEA is that as we look at it from the vantage point of early May 2018, is that it is difficult to see that the transition to the new Imo regulations will take place smoothly. There's an awful lot of work to be done. And we'll have to wait and see how the industry reacts. As far as we're aware, there will be no postponement by the International Maritime Organization of the introduction of the new regulations. We'll have to wait and see. As far as other products are concerned, just very briefly, we're seeing gasoline demand continuing to grow, but relatively slowly, because although the developing countries, China, India and elsewhere, will see decent growth in demand for gasoline, the ongoing long-term strategic decline in gasoline demand in many of the OECD countries, that will continue and that will offset the growth in the developing countries. I think at this point I'll hand over to Toril, my colleague, who will lead us through some thoughts on the supply side of the balance, starting off with the hugely important issue of investment in the upstream oil and gas sector. Toril.
What we're seeing with demand growing very strongly in the next 5-6 years, we are concerned about the level of investment in upstream. This chart is showing the combined investment in the upstream for oil and gas, and we're seeing that even as oil prices recovered during 2017, there was only a very, very limited or practically no recovery in upstream investments in 2017, after combined investment had fallen by 25% in both 2015 and 2016. Of course, the fall in investment that we saw over those 2 years were unprecedented in scale. It did come along with cost deflation. A lot of it was offset by drops in the cost for material, for services, but what we're seeing is that we have yet to see an increase on the global level in upstream spending. 2018 so far, we're expecting a marginal increase, about 6 to 10%. Of course, now we're looking to see if oil companies are adjusting those expectations and their plans for this year in response to prices rising still. But also what we're seeing is that companies are focusing more and more a larger and larger share of their upstream spending on shorter-term supplies, such as U.S. shale oil. In 2017, there was a big increase in investment into these resources, masking the continued declines in conventional supplies, and this is also the case for 2018. We are seeing offshore spending falling still in 2018, but there are some signs that there's a renewed interest in the offshore developments, and this would lead to higher spending further on as the projects move along towards development. So with companies having rather tighter budget, they're prioritizing differently the way they spend their capex. And as I said, the majority of the increases has come to the US light tight oil shale industry, but we're also seeing increased spending on conventional fields that are already operating. And what this has led to is there has been a decline an easing of the decline rates for already producing assets. It's relevant to OPEC countries, non-OPEC countries, the onshore and the offshore, as we're seeing that the companies with rather limited or small cash injections can have additional supply in the really short term by adding wells to their existing assets, spending rather limited amounts of money. But what we're seeing still is, even as decline rates are falling, the industry has to replace about 3 million barrels a day of oil supply from those already producing assets. This graph is showing conventional oil production declines. So we looked at 12,000 fields globally and seeing how much, at what percentage they fall every year. So even though the decline rates are easing, the industry still has to replace 3 million barrels a day of supply from the already producing assets. This is equivalent to the entire North Sea production currently, so it's not a small challenge. And back to the demand side, what people tend to forget is that the industry does not only have to invest to meet the demand growth that is expected of about 1 million, 1.2 million, 1.3 million per year, they also have to invest to offset the declines from the existing fields. Even so, what we're seeing is that the non-OPEC countries are adding supplies, and in the next 3 years, we're looking at a rather balanced market. Supply growth from the United States, which leads the number of countries that are adding to production, along with Brazil, Canada, and Norway. Growth from these 4 countries alone, the non-OPEC countries, should be enough to meet the demand growth that is expected globally. You have, on the other hand of the side, very steep declines in Venezuela and Angola, Mexico, China, and other countries, and we're seeing very little capacity expansions coming from the OPEC countries overall. OPEC as a whole are adding just 1 million barrels a day of new capacity to 2023. Significant investments are going in just to maintain capacity at their existing assets. So what we're seeing here, and you can see at the left-hand graph, that the supply growth is pretty heavily front-loaded in the early years. 2017, we saw that the U.S. oil production is coming back as investments picked up in those areas. 2018, we'll see the full impact of those investments and the supplies coming from the United States. Non-OPEC supply is expected to grow by 1.8 million barrels a day this year. 1.5 of that is coming from the United States alone. Growth in the U.S. will be strong also next year. And then towards the end of the second half of this period, investment levels or output will depend on the investment levels that go in, and that would of course be dependent on the price. In the early years here, we're also seeing supply growth from countries such as Brazil and Canada. These are investments that was made before oil prices fell, where we see the lack of investment or the really sharp decline in investment and the sanctioning of projects over the last 3 years is having an impact on the supply growth further out. Now we are seeing an uptick in project sanctioning and investment, but a lot of this will come out at the very end of the forecast period. So So, as I said, the United States is by far the largest source of supply growth in the medium term, is in the short term and in the medium term. In the first wave of development phase of the in the United States of the tight oil, we saw supplies growing by nearly 4 million barrels a day over a period of 4 or 5 years. As OPEC and along with 10 non-OPEC countries decided to cut back supplies to reduce the stock overhang at the end of 2016, we had prices recover, and this was leading to another round of investment in the sector, and this is unleashing a second wave of supply growth. So in our scenario, which is obviously based on prices around 65, falling slightly over the period to $60 over the period, we're still seeing the United States supply growing by 3.7 million barrels a day, with the implications that have for global markets. I will not spend too much time on the other countries, but Brazil is the second largest source of supply growth. You're seeing here that production is expected to grow by 1 million barrels a day. Here I split the Brazilian oil supply into two areas: the Santos basins, where you have the pre-salt that is being developed now. The Brazilian government has done a lot to attract investments from international oil companies, easing the restrictions on operatorship and participation of IOCs, which is clearly driving new investment into the sector. But as you can see from the blue parts, which is the Campos Basin, the more mature, conventional sort of areas, is that supplies are falling very, very quickly. Brazil is one of the areas where you've seen that the decline rates have actually accelerated, and the Campos Basin is now falling by about 15% a year, which means that last year, the new projects that Petrobras, along with its partner, brought online, 2/3 of that only went to offset decline. So you have investments in new production, but you have to also spend the money to maintain output at the existing area. Canadian production is another area that's seen growing. It's growing very strongly this year as it did last year, but now we're bumping up to capacity constraints in the midstream, takeaway capacity. It's becoming a major issue for the Canadian government, even though at the federal level they're approving pipeline export infrastructure. They're meeting resistance both in the US on the local level and also at the provincial level in Canada. And now we're seeing that the pipeline capacity is fully utilized, and Canadian producers are once again having to revert to rail, trucking and rail capacity, which is having implication on the pricing that Canadian producers are getting for their crude oil. So this is a major risk to the forecast for Canada, because if here you can see in the stacked color bars over the period that we do need to have these new pipeline projects that have been approved on a federal level to come in line, but they're still meeting resistance, and it's not really a done deal. So without them, it will be a challenge for Canada to increase production as they have set out. North Sea, just quickly, North Sea production has been falling very sharply over the past decades. The region was written off as a mature basin and in terminal decline. Now we're seeing renewed interest, the discovery of new large fields, and a very, very significant improvements in cost and development. So after 15 years of declining production, we're seeing that North Sea production is coming back at the end of towards the 2020s. Operators have been able to cut cost. The break-even costs from the projects have come down from $90, $80 to now, for some of the larger fields, less than $20 a barrel. So the North Sea is again able to compete with resources in any parts of the world, and in the US shale in particular. So we're seeing growth coming back to the North Sea from the early 2020s. Russia production staying relatively stable. As you know, Russia agreed along with OPEC to cut production at the end of 2016 to support oil prices. Lower oil prices did not have the impact that we had foreseen on investment by the companies. The decline of the ruble exchange rate meant that the companies were able to maintain capex spending. Sanctions meant that they had difficulties finding financing in international markets, but they were clever and they able to maintain spending. Going forward, we're seeing that production can increase still slightly in Russia, but the pressure that the lower prices had on the government budgets rather than the companies meant that the government now is more inclined to support higher prices. So now with Russia and Saudi Arabia in particular talking about extending the relationship and the production pact, the agreement that it put in place in Vienna, and institutionalizing this relationship seems to suggest that there will be some sort of production management going forward, whatever form that will take, with the support of the Russian government. And also the companies now that are coming around to see that they were the biggest beneficiaries of the production cut agreements in terms of additional revenues. They cut very little and they gained greatly. So even the companies are saying now they will focus on value and return on investment rather than growth. So we're seeing production stagnate and then fall off towards the end of the period if sanctions stay in place. Asian supplies have seen Asian countries have seen the biggest declines in production. China, Vietnam, Malaysia, Indonesia, all seeing declines. And this is having implications for trade going forward. Asia is already the biggest importing regions of oil in the world, with the region's production falling further and demand seeing the strongest growth. It's not only China and India, as Neil said, that accounts for half of global demand growth. Several of the other economies in Asia are growing very strongly, and with their own production falling, their import requirements will also rise over the period. So.
Thank you. We're now going to focus on one or two issues that arise from the numbers we put forward for demand and supply. Just a reminder of the big picture so far. We've got demand increasing by 6.9 million barrels a day. We've got total capacity, production capacity increasing by 6.4 million barrels a day over the next few years. 5.2 million barrels a day from non-OPEC, only 1.2 million barrels a day from the OPEC countries. So you can already perhaps see a little clue as to where we think the market balance may be in a few years' time. In the meantime, as a consequence of the big increase in production in the United States, as we've seen over the last decade or so, and the resurgence that Toril pointed out just a few moments ago, the issue about the United States place in global markets is becoming extremely interesting and indeed extremely pressing. In the first wave of production growth in the United States after 2008 or so, up to the peak year, the most recent peak of 2015, we saw that the first wave of U.S. oil production was absorbed within the U.S. market, and the main reason for that was, of course, that it was impossible for U.S. crude producers to export to international markets. U.S. crude did move to Canada, but it was not allowed to move to international markets. That restriction was removed a couple of years or so ago. But during the first wave, when exports were not allowed, the big increase in U.S. production was absorbed by domestic refineries, or it went into stocks, which of course increased enormously as production increased. Now, as far as the second wave is concerned, which is the time period we're in now, where, as Toril pointed out, U.S. production is going to go strongly over the next few years, we think that the second wave of U.S. production growth will and can be absorbed in international markets, because although the crude is lighter, we believe there will be demand for it, particularly to meet the rising demand for petrochemicals, so it will be purchased as a petrochemical feedstock. It will also have advantages because it's a low sulfur crude, so that will help with, amongst other things, the implementation of the Imo Regulations after 2020. So we think there'll be a market for US crude in Europe. There will also be a bigger market for US crude in Asia. And indeed, we've already seen that crude oil exports from the United States have already reached levels of about 2 million barrels a day, not necessarily on a sustained basis, but in certain relatively short periods of time. And we think that as the crude export capacity in the United States grows, which it will over the next few years, and the United States has the ability to ship its oil to wherever it can find customers, that the US will move increasing volumes of oil to China and indeed to Europe and possibly elsewhere. But China and Europe will be two particularly important markets for the US oil. We think that the argument that the US production is the wrong sort of oil, we do not think that that argument is valid. Now, another consequence of our numbers and of our research is the changing pattern in terms of trade. And the first version of this slide, or the first part of this slide, shows you that how the United States and China have swapped places in terms of who is the biggest net crude oil importer. We take the slide back 15 years or so when the US was importing 10 million barrels a day of crude oil, which it was still doing up to about 2007, 2008. Crude imports have plummeted in the US as domestic production has increased. And in the meantime, China has seen its imports increase sharply because its domestic demand, its domestic market is increasing, and as its own production has either been stagnant or indeed has fallen sharply in recent years. So the US and China have crossed over. And as we move forward to 2023, we see continued declines in US imports as domestic production continues to ramp up. Meanwhile, in China, as domestic demand continues to grow strongly, we see a big increase in Chinese imports. So, by 2023, China essentially becomes the 10 million barrel a day net importer, which the United States was some years ago. The US in the meantime plummets to about 5 million barrels a day, something like that. And we should not forget India in all this, because although the rate of growth of the market in India is significantly lower than we saw in the early flashes of development in China, it's still growing pretty strongly. As I pointed out earlier on, and Toril reminded us, China and India contributing 50% of global oil demand growth. So India's import requirement is growing steadily, and indeed by 2023 it will just about overtake that of the United States. So these are very interesting developments in international trade arising primarily from the revolution that we've seen in the United States, but of course the ongoing development in China. Now, after 2020, we believe that there will be no single net crude exporting country in Asia. Traditionally, a lot of oil has gone from the Middle East to Asia to meet the ever-rising demand, but we think that the Middle Eastern countries, because of their own rising demand and their own lack of investment in production capacity, will only be able to provide about 1 million barrels a day more so oil to Asia. And that means that most of the 3.5 million barrels a day of extra oil that the Asian region is going to need, most of that will have to come from elsewhere, from outside of the Middle East, the Atlantic Basin, the United States, Brazil, and some other producers. And that, of course, raises some issues over the increasing the length of journey times to get oil to market, and that has some security of supply implications. But what we see over the next few years is the change, and this graph shows it perhaps a little more easily, is the fact that the United States is going to be contributing an enormous increase in the volume of exports from non-OPEC countries. We see some growth in Norway over the next few years as its production expands dramatically. The same from Brazil. Within the OPEC countries, there could well be increases from Iraq, depending on the political situation, and from the UAE, and possibly over the next few years also from Russia. We'll have to wait and see. But the main point is that, as the title of this slide suggests, is that most incremental crude exports in the next 5-year period or so will come from outside of the OPEC countries. And another quick slide, which is a slightly unusual presentation, but it's an attempt to show what the changing shape of the barrel, so to speak, looks like. Prior to the shale revolution, on the left-hand side of this chart, you had a tendency for the global barrel to become heavier and sourer. That was the expectation before the shale revolution was invented. Now, of course, we're a decade into the shale revolution in the US with ever-rising volumes. We're finding that is impacting on the shape of the global barrel. And we now have very much higher volumes of lighter crude coming from the US and elsewhere, crude and NGLs. We still have plenty of heavy and extra heavy oil, of course, still from the Middle East, and possibly if Venezuela gets its act together, that will be restored. But we're seeing a squeezing to some extent of the middle of the medium grades. And there are challenges over the next few years for refiners. Up to 10 years or so ago, the fashion was to invest to process heavier crudes, and a huge amount of investment took place around the world, both in the United States Gulf Coast and also in China and India. But now, of course, the world is changing, and there will be adaptations required on the part of refiners to be able to process not just the very heavy crudes, which will remain in abundance, but also lighter feedstocks coming from the US and elsewhere. So there are challenges for the refining industry, as of course there always are, and of course they will blend. It's not just a question of using only one type of oil or one or another. But there are challenges for the refining industry over the next few years in terms of the crude diet. Now, we mentioned the Middle East and the fact that there will be less availability from the Middle East to meet Asian demand than might otherwise have been the case. And one of the reasons for that is that many of the Middle Eastern countries have very large domestic markets which have been growing pretty quickly and will still continue to grow even though subsidies may have been reduced or even eliminated. And the Middle Eastern countries need to refine more oil. So, on the left-hand side of this chart, the two slides you can see, we saw in the last 10 years or so, China and India invest hugely in the refining sector, and in some cases over-invested. In the case of the Middle Eastern countries, we're now seeing that their investment in refining is ramping up considerably over the next 5 years in Saudi Arabia and in Kuwait and some of the other countries. By contrast, because we are not seeing investments on the same scale as we might have expected in the upstream sector in the Middle East, the chart on the right-hand side shows that the investments in the refining sector in terms of capacity are now outstripping investments in the upstream sector, and that is an interesting change. There are strategic reasons. Obviously, they need to supply the domestic market. They would also like to expand their exports of products, also higher value products to growing markets. And also, as well as investing in capacity within their own countries, of course, there are investments that have taken place and are taking place on the part of many of the Middle Eastern countries in developing country markets, and not just developing countries, also in the United States, where Saudi Arabia maintains a major stake. So there's a lot of activity in the Middle Eastern refining industry currently and over the next few years, and perhaps that's a slightly more interesting sector than might have been a case in the more recent past. What we're going to do now is move to a summary slide, and what we've attempted to do is take our expectations for demand and take our expectations for supply growth over the next 5 years and show what and try and demonstrate what that could mean for the market balance. And essentially the way we're showing this is that in the blue parts of the stack you have the OPEC capacity, And then on the right-hand side, and the red bits, you have the call on OPEC crude and stocks over the next 5 years. And essentially, because of the fact that global oil demand is growing faster than global oil supply, there is a tightening of the market, and there is a shrinkage of the spare capacity cushion that exists in the marketplace. And we think that by 2023, if nothing changes and our numbers were to be absolutely accurate, and of course the market won't stand still, but were that to be the case, we are looking at a significant market tightening. And in those circumstances, as we've seen in the past, particularly back in 2007, the fact that the spare capacity cushion is reduced to relatively low levels means the market is vulnerable to price spikes from changes in market conditions or geopolitical incidents, and that raises the specter of possible price spikes, which of course, as we have seen historically, does not benefit anybody. There are a lot of uncertainties around the outlook, of course, needless to say. And on this chart, we list a few. There are others that you might think of. But as far as we're concerned, some of the key uncertainties in the next 5 years include: will the pace of demand substitution in countries such as China in the transport sector, will that pace increase, perhaps by government directive? We've also seen more recently the substitution of oil in the power market in some countries, which perhaps less attention is paid to them, such as Pakistan, such as Iraq, and in other countries where oil is being pushed out of the power sector in favor of natural gas. In the case of countries like Pakistan, big increase in imports of LNG. So there are substitution pressures of various kinds around the world. The OPEC or the Vienna Agreement, will that be maintained? We don't know. We'll have to wait and see. Certainly with oil prices having risen very sharply recently to what may or may not be a new normal, the question will be posed to OPEC when it meets in June: are prices high enough now that you can perhaps ease the agreement? We don't know. We'll have to wait and see. The potential for the US shale sector, Toril spends a considerable amount of time trying to understand the impact of higher prices on perhaps a higher rate of growth in production in the US light tight oil sector. We'll have to wait and see. But will the bottlenecks that we're seeing in Canada and to some extent in the United States, will those bottlenecks be eased to allow for a higher rate of production growth than we currently expect? The investment strategies of the companies, Toril displayed our chart suggesting that investment had fallen very dramatically in recent years and was not increasing dramatically this year. Will the companies feel more confident that a higher level of prices is now here to stay, and will that encourage them to bring forward investment decisions which have not yet been taken? Having said that, the signs of cost inflation in various aspects of the value chain, equipment, labor, there are signs that cost pressures are beginning to assert themselves, and what impact will that have? And last and certainly not least, geopolitics, which of course is always with us. In the very short term, and perhaps with longer term implications, we have the collapse of the oil industry in Venezuela. We have considerable uncertainties about Iran's ability to continue to export oil because of the possibility of the cancellation of the nuclear agreement, but also if sanctions are reimposed on Iran, will they be able to invest in expanding their production capacity, which we think otherwise they might be able to do. And there are other uncertainties in countries such as Libya and Nigeria, and there will be others which I'm sure you could add to the list. The imposition of sanctions on Iran we just dealt with. The possible tightening of sanctions against Russia, we can't be sure about that. What implication will that have for investment and growth in Russia? And trade. Of course, there is a potential, it's described as a trade war between the United States and China, What implications will that have for global trade? Because global trade is growing very significantly. If global trade suffers as a result of the imposition of tariffs, that will have implications for oil demand, because lots of trade takes place at sea and by trucks. But of course the implications of trade, of the lower trade for the overall health of the global economy is something we need to be aware of. So there's an awful lot of uncertainties out there. These are just a few. And you may have your own ideas as to others that should be added to the list. Finally, just to re-emphasize the points that we've made in the slide pack, is that we see world oil demand continuing to grow robustly out in 2023 with big support from petrochemicals. Of course, there are efficiency improvements taking place which are limiting the rate of growth, but it still remains strong. The non-OPEC output we're expecting to see in the next 3 years or so will exceed the global increase in demand, but thereafter there is uncertainty as to whether whether new projects will come on stream to deliver the kind of supply growth that we think is necessary. The US crude, there's going to be a lot more of it. We think it will find markets around the globe. Upstream investment, the IEA emphasizes this regularly in various publications and statements. We believe, even in the world of lower costs, that more upstream investment is needed today to meet the growing demand, and not least, of course, to offset the declines we see from mature fields every year. And finally, as the spare capacity cushion shrinks, which we currently expect that it will, that raises issues over security of supply. It raises issues over the possibility of price spikes in certain circumstances, which we think are not in the interest of the global economy. I'll finish at that point. The book itself, or the research itself, is 135 pages. There's obviously a vast amount more detail than we're able to put across in a relatively short presentation. But I hope you found the points we've made to be of interest, and any questions or observations are very welcome. And you're very welcome to ask questions also about the very short or the much shorter term outlook for the oil market as well. Thank you very much.
Thank you very much, Neil and Toril, for outstanding presentation, a holistic approach with key uncertainties. This year it has a forecast for the future with a lot of changes facing our sector. No? This is the time for Q&A section, and they are open to answer whatever you ask about them, about the PEP policy, about the management, about the prices. Here we have one of them. Mr. Miras, please introduce yourself before.
Thank you. My name is Pedro Miras from Cores. First of all, congratulations to Toril and me for the presentation. It has been very good. And just a question regarding India and China, that are key partners, key countries in the future. In the graph that we have seen there, the future expectation for oil import is very different. China is going to reach 10 million barrels per day, and India is going to reach only 4. And they started at the same point several years ago. Is there any reason for that? Because population seems to be quite similar. This is my question.
Over 15 or 20 years or so. So we've seen very dynamic rates of growth in China for very nearly 20 years. And oil demand growth in particular really exploded up to 2000. One of the factors, by the way, I always thought that people think that a level of oil prices is here to stay. Well, back in 1999, 2000, the oil price went down to $10 a barrel. We all thought low oil prices are here to stay. There were various arguments as to why that was. Nobody saw the rate of demand growth in China coming, which really took off in the early years of that century. The point being, China's been growing faster for a very long time. India is growing, yes, strongly, but there are still, shall we say, bottlenecks in the economy in terms of the liberalization of markets, the liberalization of the economy overall, and that's why the rate of growth in India remains slower than China, although there are huge reforms taking place, and gradually over time we may well see, not necessarily within a 5-year period, but we may well see that the rate of growth in India does begin to accelerate. But you're right to point out, yes, it's less dynamic than China. That's because China has been developing much faster and much longer.
Question for here you have another one.
My name is Fernando Manuel. Thank you very much for your excellent presentation. I have two very small questions. The first one is about if you can explain why you expect an increase in the international downstream expansion by NOCs. Because if you don't expect an excess of supply, why do you expect this tendency? Because it's quite rare, it's quite unusual when you look into the past that NOC expand in international downstream. You have several examples, as Venezuela in Citgo, or as Saudi Arabia in Motiva. You have some examples, but very few ones. So why you expect this new tendency? And the second question is something that is a bit worrying concerning the conventional oil, is the rate of declining discoveries. Really, when you see this has been published by the International Agency, the slowness, the decrease in the rate of new discoveries in conventional. So how can you make this compatible with your projection, with your expectation of increase in conventional oil for the future? Thank you.
There's a lot there, and Toril may chip in a second, but just very quickly, as far as the discoveries is concerned, I think I've got the figures correct here, that we produced something like 36 billion barrels last year, and the discoveries net last year, I think, was something like 4 billion barrels, something like that, so which is an all-time low. So that's a very good point that you make just there. Just very quickly about the producers. Back in the 1980s, yes, you're right, at a time when the OPEC countries had enormous spare capacity and demand had fallen dramatically for 3 years in a row, they decided, and with the rise of the North Sea, they decided that security of demand was very important for those producers. So they took the decision to invest in refining projects overseas. I remember working in Venezuela back in the 80s, and investments in the US and indeed here in Europe as well, because you have outlets, you have guaranteed outlets for your crew. Saudi Arabia did the same thing, Abu Dhabi did it, Kuwait did it, I think even the Libyans did it as well, but maybe other examples that I've forgotten. Now, fast forward to 2018, and you ask the question, why are they doing this? Well, I think to some extent it comes down also to security of demand for their crew, because although there is the possibility that investment will not take place sufficiently to have plenty of spare capacity around, there are certain markets in the world which will remain very competitive, such as China, and it makes sense for producers such as Saudi Arabia and indeed others, if they have the desire to do this, to ensure that they have a foothold, a direct foothold in growing markets. It makes sense to have a direct foothold in that market in the downstream sector, and I think that's a driving force behind their decision. We'll have to wait and see how far they decide to take this, whether they do it by themselves or they do it in partnership with either other companies or with or whether they do it in partnership with other companies or not. But I think it makes some sense in trying to capture the added value of having a foot in the domestic markets of growing, fast-growing countries. Do you want to add anything?
I think within several of the producer countries now, we're seeing that statements from the companies themselves, or from ministers or leaders of those countries, that there is a concern about the health of demand. All demand will go out. We hear it from Saudi Arabia, and they asked the questions, what if oil demand growth falls away with the policies towards moving to other fuels and having cleaner economies. So I think it's partly related to the concern about securing markets, as Neil said, for their supplies. And as we're seeing with prices sort of wrapping up, we're having a lot of goods coming from producers that have higher cost supplies than the Middle Eastern countries themselves, because the resources in the Middle East and Russia are the lowest cost in the world to develop. But the economies, to balance the budget, the fiscal break-even price is higher than just the operating and levels for the resources. So they are requiring a higher price, but they're seeing that they're having competitions from other places. So in Indonesia, when Saudi Aramco signs deals with Pertamina to build refineries in Indonesia, and we're seeing the Russians going into India, and we're seeing in China and so forth, I think it's really about having a secure supplies. And we see with Saudi Aramco, Tiva in the United States, that even though crude oil imports into the United States have fallen off very sharply as their production increases, the Saudi crude deliveries are holding up steadily because they're supplying their own refineries and others. And so they have sort of a market there, and I think that's strategy. On the exploration, you're asking about the discoveries. It's true, it was the lowest that has ever been discoveries last year. We talk about upstream spending, but the segment of the upstream spending that has fallen the most is the exploration spending. It sort of makes sense if you're trying to prioritize your investments in a period of low prices. And we're seeing as companies are focusing on bringing on supplies that have a shorter payback period, and that is not exploration. So this is a concern. Now there is enough over-reserves on the books for the companies to continue to expand productions for years to come. But the problem will come later. And we're not seeing really an uptake in exploration at all. So the only resources that are being discovered are in the United States. But for conventional oil, that is a concern. Not necessarily for this decade, but after the 2020s.
Okay, like another question or something like this. I was asking you about the key uncertainty about the price and the OPEC and non-OPEC agreement, and what will you forecast for the future with this agreement? Can you comment on that?
If you read the actual Vienna agreement,
No, this is what
which was made at the end of 2016, what it says is that they note that global oil stocks were at record high levels, and global oil stocks need to be brought down to what they described in their words as normal levels. That's what it said. That was the point of the agreement. Now, it didn't specify what normal actually was. It doesn't say that in the agreement itself. However, since then, we've all become used to the fact that what they apparently mean is that stocks should fall down to the 5-year average. Despite all the imperfections of the fact that demand is rising in the meantime, that's a moving target. But that's what they said. And of course, because stocks information on a global level is imperfect, there are huge black holes around the world in terms of knowing how much oil is held in stock. The only reliable set of data is OECD stocks, so that's published every month. We can see that. So in every monthly edition of the IEA Oil Market Report, we show the stocks of the OECD against the 5-year average. In the last report, we pointed out that the OECD oil stocks have fallen very close to the 5-year average. It's within striking distance. And we think that very shortly we'll be seeing data to prove that the average stock level has been achieved. Therefore, in the last edition of the Oil Market Report, we wrote mission accomplished with a question mark. In other words, have they achieved what they set out to achieve, i.e. reducing oil stocks down to normal levels? If that is the case, the question that you would ask the producers is, well, if you hit your target of reducing stocks to normal levels, do you still intend or wish to continue with the production management agreement? Now, the current policy is that they will maintain the current agreement until the end of 2018. That's what they have said, and that's what they may continue to do. But of course, between making the agreement and achieving it, lots of things have changed. And of course, nobody anticipated the collapse of Venezuela. We all thought it was going to go down, but nobody anticipated by how dramatically it would fall. So production has dropped off a cliff in Venezuela, so they have reached the target perhaps a little quicker than they intended. Production from Mexico has gone down far more than perhaps we anticipated. So the facts have changed, and there's a saying that when the facts change, their opinions change. So that now that the market facts have changed, when the OPEC producers meet in June, they may well have a challenge to explain what their production policy will be. And the other question, which would be a good one to ask, is if when they meet in June, the oil price is still at $73, $74 a barrel, or even higher, you would perhaps ask, is that a satisfactory price, or do you wish to see oil prices go even higher? You have to wait and see. There's a lot of uncertainties. But those are the challenges that OPEC faces, because global oil prices at these kind of levels, if sustained through the rest of 2018, we believe will have an effect on global oil demand growth. We don't know how much. We still need to do a lot of work on that. There's a lot of uncertainties. But just in the last 10 months or so, crude oil prices have increased from $45 a barrel to nearly $75 a barrel. Now, don't tell me that isn't going to have an impact on the outlook for global oil demand growth. We'll have to wait and see.
Okay, we can see some more questions. The last question. There are two questions now. Well, it's open. The last two questions, okay? First of all,
My name is Luis Casado from RS Bank. I would like to, and thank you very much for the nice information on the picture, no? In 2023. But I would like to know if it could be any change in those forecasts if in the coming 10 days Mr. Trump decided to impose the sanctions in the Iranian oil again. How do you see it?
Well, that's obviously an issue everybody's watching. We don't yet know what will happen. If, for the sake of argument, the nuclear deal were to be seen to be coming to an end, and the prospect of a renewal of sanctions were to take place, even if that were to happen, it's not as if all the oil will vanish from the market overnight. In the previous round of sanctions that were imposed, the United States and indeed the other and its allies offered a period of adjustment for suppliers or importers who were taking oil from Iran to make other arrangements, which they did over a period of time. We'll have to wait and see what the US decides. You see estimates out there that the impact of the sanctions this time around might be lower than was the case previously, because other countries may not agree with the decision. We don't know. That's a political matter and not the IEA's job to forecast that. But clearly, the growing possibility that the nuclear deal could come to an end is weighing on the mind of the markets, and it is one of the factors, alongside the fall in Venezuelan production, falling stocks, it is one of the factors which lies behind the recent increase in prices.
how much oil is Iran producing now?
Well, Iran produces just under 4 million barrels a day. It's about 3.8 million barrels a day, something like that. Prior to the nuclear deal being agreed, somewhere between 1 million and 1.2 million barrels a day of Iranian oil was kept off the market. That's a fact. So that gives you an idea of what we might be talking about here, although we can have no idea if sanctions were reimposed that that level of shortfall would take place. We'll have to wait and see.
Okay, the last one.
Jaime Segarra, first of all, thank you very much for your well-documented and synthetic presentation on this difficult subject. I have two questions. The first one is whether you have considered in your forecast that other countries than the US get really into the LTO market, and with the ability to react quickly to demand evolution, they can change a little bit the picture. The second question is if you have considered in your forecast the effect of decarbonization policy and the effect that manufacturers are building more efficient engines, which curb down the demand trend. I'm basically thinking of your 6.9 million barrels per year. Do you think this could change? Thank you very much.
Yes. So, to answer to your first question, yes, we are looking at developments of light tight oil in other countries than the United States, but we do see the United States being unique in its ability to grow resources. In our forecast, we are including growth from Argentina, where there's already a lot of activity going on shale resources. A lot of international companies are there, but the oil production is still limited in scope. I mean, I think we're about 50,000 barrels a day now. Companies are increasing investment, but the infrastructure and resources are not the same level as in the United States. So even with continued spending and increases, we're forecasting growth for sure in Argentina, but nowhere near sort of the levels that you see in the United States. We also have light tight oil developments in Canada. These are some of the plays that are stretching from the north of the United States and into Canada and other areas. But still, we're talking about a few 100,000 barrels a day, not 5 million. It's a different scale. Mexico has resources that are not being developed currently. Some of these assets were offered in the latest rounds for international companies in the opening up in the sector. We'll have to see if these are a priority for companies to go in and develop this and develop it quickly, or if they will focus on the onshore, the already conventional shallow water, deep water, onshore assets that are being offered. For the time being, Mexico has resources, but and it will be a key driver to Mexico in the longer term, but perhaps not in the time period that we're looking at to 2023. After 2025, it will be key to be able to sustain resource production. China resources, we're not seeing, they're making some progress in developing the shale gas. In terms of oil, there's nothing much going on. Russia, the same thing. They have resources, but it's in remote areas. There's a challenge, like in China, water, access to water in the areas. In Russia, the sanctions are prohibiting international oil companies to go and help develop these resources. And for Russia, they have easier and cheaper oil to develop still in their conventional resources. So we're not seeing a big area. So to answer your question, into the early 2020s, we're seeing U.S. being the key country, followed by Argentina and Canada. There's potential in Mexico, but otherwise we're not including. In Europe, we're not including anything. In other areas, it's they're saying, companies are saying that the resources are harder to develop. It's not the same geology that you have in the United States that is making it very
a couple of quick points on demand. Firstly, addressing the issue about engine efficiencies. The IEA has a transport model, and included in that are assumptions about improvements in engine efficiencies. Yes, of course, and not just clearly the engines themselves, but in terms of materials used in vehicle manufacturing, in terms of vehicle weight. So there's a lot of factors, and that's not just, by the way, vehicles, because obviously the aviation sector is hugely important, because there are improvements in the efficiency of aircraft, and then land-based transportation, whether it be vehicles, passenger vehicles and trucks. So assumptions on improvements in engine efficiency is taken into account, and it may well be that if the improvements accelerate, that it could have a bigger impact on growth than we currently think. the penetration of electric vehicles. In the short term, at least, in the 5-year outlook, globally, it's unlikely to have to shave more than about, this is in the passenger car sector, more than 250,000 barrels a day of demand for liquid fuels. Further out, the numbers start to get a lot bigger. Just finally on demand, a quick point on the Imo regulations, because I should have put a little bit more quantity onto this. What we're expecting to see in 2020, when the Imo regulations are implemented, which we assume they will be, that the